In this video tutorial, we are going to construct a cash budget for Adventures Limited. Do remember, as we work our way through this, that you can pause and rewind at any time. First of all, we'll have a look at the question. In fact, we'll just read down through the question. Starting here, Adventures Limited is setting up a new business on the 1st of July next year. The directors have asked you to prepare a cash budget for the first 6 months. So there's our timescale. We're going to go from the 1st of July for 6 months to the 31st of December. They've supplied the following information. The directors will invest $50,000 in the business on the 1st of July. All the sales will be on credit. Wages are paid in the same month they're incurred. So if we just have a look down here, there's the sales figures there, and there's the wages figures there. So that's the information we need for those two. It is now expected that debtors will pay 60% in the month following sales and the balance 1 month later. So that is related to the sales being on credit. Goods are sold on credit. The people you sell to are your debtors. Included in the estimate for overheads is $500 per month for depreciation. So there are the overheads. So 500 of that, these figures here is depreciation. So in other words, that 5,000 there for the month of July includes depreciation. Depreciation is not a cash flow, so we need to take it out. It's not a cash movement, never is. So if it's in the figures, you need to take it out. So therefore the overhead figure for July will be 4,500, for August 5,500, and so on down. The company intends to pay for materials, there's the materials, 2 months after receipt. So the goods coming in May will be paid for in July, and so on. Overheads are paid 1 month after they are incurred, so that is actually linked in with note number E there. And then finally, a new computer will be purchased in July for $10,000, paid for half of September and half in October. So we are now going to construct a cash budget and put this information into the cash budget. We're going to do the cash budget in 3 steps. First, we're going to identify all the cash inflows, or if you prefer to use the term, cash receipts. Second step, we're going to identify all the cash outflows, or prefer the term, the cash payments. And then thirdly, we're going to have a look at the impact of all these cash inflows and cash outflows. So starting off with the cash inflows, I'm going to construct my cash budget, starting with the first step there, the cash inflows. So it'll look something like this. You can see across the top, I've got the months. You always have the time across the top, so July through to December. Now here, I've put in the sales figures. Now, you also note that I've double underlined those sales figures. Those sales figures are not actually part of the cash flow statement itself. They are part of the information that I will need to work out the cash flows. It's very useful to have them there, but it's not compulsory. You may decide not to have them. This bit here is where I'm going to identify the cash inflows. I'm going to have the opening capital, and then I'm going to work out the cash from sales. There are no other cash inflows in this question. There's the capital and there's the cash coming from sales. So we'll do is we'll just run through the first couple of transactions here and see how we're getting on with them. So if we go and have a look at the question, it says here, note number A, the directors will invest $50,000 in the business on the 1st of July. Okay, so what I'm going to do is I'm going to pop that in here. Opening capital in July, 50,000. Now, if I go back and have a look at the cash flow from sales, here's the sales here. So they're listed there, 15,000, but I have them written across the top of my cash budget anyway. Now we can see here the sales are going to be on credit, and the debtors will pay 60% in the month following the sale, and the balance 1 month later. So I have that sort of set up here. So of those 15,000 euro worth of sales, 60% will come in not in the month the sale is made, but in the following month. And 60% of 15 is 9,000. Now of those 15,000 euro worth of sales in July, 40% will come in not in the month of sale, not in the following month, but the month after that again. And that is 6,000. Now do remember, you can pause and rewind this at any time. The thing about this is, once we have it set up and we understand it, we're simply just going to copy this across. So I will now just fill in the figures quite quickly, but again, as I've said earlier, you can pause and rewind at any time. So 18,000 worth of sales in August. Well, 60% will come in 1 month later. That's 10,800. And the balance in October, 7,200. September, 60% will come in October. That's 12,000. And the balance of 8,000 will come in November. October sales, 25,000. 60% of that is 15. 15,000 comes in November. And the balance, 10,000, comes in December. So those two figures there represent the cash inflow from October sales. November sales, well, we'll have 60% in December, 16,800. Now the balance goes into January. And then for December sales, that will spin over to February and March. We're not asked to do anything for the following periods, so we're just going to stop and ignore it. That will not always be the case, but in this question, it is the case. So once we have identified the cash flows up to the 31st of December, we finish with this part. Now, as I mentioned earlier, there were no other cash inflows, so we're simply going to add up the cash inflows for each month. So in other words, based on this plan, the projected cash inflows for the month of July come to 50,000. The projected cash inflows for the month of August, well, they come to 9,000. The projected cash inflows for September, well, it's the 10,800 plus the 6,000, so it's 16,800, and then so on across. 19,200 for October, 23,000 for November, and 26,000 for December. Now, this is a little bit messy, so I'm just going to tidy it up quickly. Now, a little bit tighter. So do remember, if you want to go back over any of this, you can rewind anytime you like. That's step 1, the total cash inflows completed. Or remember, if you prefer to use the term cash receipts, it's the same thing. Now we need to go back and have a look at the payments. So if I go back to the question here, we can see the payments will be, well, wages. I'm going to put those in. I have the overheads, so overheads to go in. We have the payment for materials, and we have the computer. So there will be 4. There will be 4 cash payments. So what I'm going to do here is I'm going to start off by listing cash outflows, or if you prefer cash payments, and I'm going to list the 4 items down here. So I'm just going to pop those in, and then we'll look at putting in the figures. Pop that in there. So there we have the wages, the overheads, materials, and the computer, and we have a row here for the total cash outflows. So I'm going to go down through these cash outflows one by one and put the figures in. So back to the question then, we can see the wages incurred, they're listed here, and wages are actually paid in the month they're incurred. So the figure for July will be 4,000, for August 5,000, and so on. So I'm just going to pop those in. So 4,000, 5,000, 4,000 in July, 5,000 in August, 7,000 in September, and then 8, 6, and 4 for October, November, and December. Next one we have is the overheads. So if we just go have a quick look at the overheads. Now we've already discussed this. The overheads for July are 5,000, of which 500 is depreciation, so it has to be removed. So it's 4,500 worth of overheads for the month of July, but the overheads will be paid 1 month after they are incurred. So the 4,500 for July is paid in August, and then so on across for all the others. So the overheads for July, 4,500 is paid for in August. The overhead for August, 6,000, reduced by 500 to 5,500, paid in September. And then likewise the amount paid for September, which will be paid in October, 7,500, and then 9,500 paid in November, and 9,500 paid in December. The materials are slightly more straightforward in that we have the materials listed here, and we can see there, note number F, the company intends to pay for materials 2 months after they're incurred. So the materials from May get paid for in July, June paid for in August, July paid for in September, and so on across. So I'll just pop those figures in. So the materials, 10,000 is paid in July for May's figure, 12,000 is paid in August, 12,000 is paid in September, 10,000 in October, 10,000 in November, and 8,000 in December. Finally, I need to put in the figure for the computer. So back to the question here. Note number H there has the computer. They're going to purchase in July, but when do they pay for it? That's the key. It's paid for half in September and half in October. So that will simply be 5,000 in September and 5,000 in October. So I'll just bring this across here to September. 5,000 will be paid there, and 5,000 will be paid in October. Now, as we discussed earlier, there were only 4 cash inflows and, I beg your pardon, 4 cash outflows, so that's the 4 from there. So we need to add up each one of these months individually. So in other words, the total cash outflows for July will come to 14,000. The total cash outflows for August, which is these 3 figures here, comes to 21,500. For September, it's 29,500. For October, 30,500. 25,500 for November, and 21,500 for December. Now, that is the total cash outflows, or if you prefer the term, total cash payments. Now, again, this gets a little bit messy, so I'm just going to tidy it up. If I just tidy it up, there we go, there's a little bit tidier. Now, the third and final bit is to put in the impact of all of this. So I'm going to have 3 rows down here. I'm going to have the net cash flow for each month. I'm going to have the opening balance, and I'm going to have the closing balance. So I'm just going to put in those 3 rows now. So there they are, the net cash flow, the opening balance, and the closing balance. So the net cash flow will be the total inflows minus the total cash outflows for each month, and for the month of July, the net cash flow comes to 36,000. Opening balance, we are going to define the opening balance as the closing balance from the previous period. Now, since this business starts on the 1st of July, there was no previous period, so therefore the closing balance at the end of July will be 36,000. So based on our projections here, we believe that the cash balance at the end of July will be 36,000. Now that 36,000 will become the opening balance on the 1st of August. Now for the month of August, 9,000 cash is projected to come in, projected to spend 21,500, which will leave us with a negative 12,500 net cash flow. In other words, that's a net cash outflow. Starting the month with 36,000, that would mean that at the end of the month they would be projecting to have 23,500 on hand. Now that becomes the opening balance for the beginning of September, and so on across. Do remember when we're working through this, you can pause and rewind at any point. So continuing on down then, total cash inflows for September, 16,800. Total cash outflows for September, 29,500. Net cash flow minus 12,700. So minus 12,700 plus the 23,000 leaves them with 10,800 at the end of September, which becomes the opening figure for the beginning of January, at the beginning of October. October, 19,200 comes in, 30,500 projected to go out. That's a minus 11,300. In other words, 11,300 more will flow out of the business than flows into the business. Now, they're starting the month with 10,800, which means they're going to end the month with a deficit of 500. So going into November, they'll have a net negative cash figure of 500. Now, in the month of November, 23,000 is projected to flow in, projected to spend or flow out 25,500, which gives us a negative 2,500. So a minus 2,500 and a minus 500 gives us a minus 3,000. So that gives us a minus 3,000 projected cash figure going into December. Now things improve a bit in December. They're projecting to have 26,800 coming in, 21,500 going out, which is a positive cash flow of 5,300, which means at the end of December we will be looking at a projected cash figure of 2,300, and it's a plus figure, which means they're projecting to have that cash. Okay, that ends this particular example. Thank you.